Hello everyone, welcome to Safe Stock Investments. This video presents the PE ratios of two companies. One is the Coal India Limited, which is public limited company with face value of rupees 10 per share, and another one is Ultratech Cement Limited, which is a private sector company with face value of rupees 10 per share. The P ratio of these two companies are calculated and shown for 5 financial years starting from March 2022 to March 2026. The PE ratio is very important ratio which is widely used by the stock investment analysts as well as equity investors before buying the stock. So we have to understand what is actually revealed by PE ratio. What is the role and importance of PE ratio in deciding whether to buy the stock or wait for some time. So PE ratio basically tells you whether the stock is overvalued or undervalued. If the stock price is high, the PE ratio will be higher. If the stock price starts reducing, the PE ratio will comes down because the P ratio is calculated by considering two important parameters. One is the current market price, which is highly fluctuating daily, and earning per share, which is calculated for the company once in 3 months. So quarterly results tells you the earning per share. That is not going to change every day. That is going to be constant for certain accounting period. So therefore, only one element is highly fluctuating, that is the stock price. So if the stock price is continuously increasing, the P ratio will increase. It means it is overvalued. If the stock price continuously comes down, then the P ratio will come down. That indicates the stock price is undervalued. As prudent stock market investors, always the investors would like to go for bottom fishing, that is buying the stock at low price or at reasonable price. So it is better for the equity investors to find out and calculate the P ratio and compare over its speeds or over the previous periods. So if the P ratio of the stock is considerably less when compared to other companies in the same industry, or when compared to the previous periods, it is better for the equity investors to buy the stock. Similarly, if the P ratio is increasing, it is better for him to wait for market correction. Similarly, the investors' confidence in the company's future earnings also will influence the P ratio. Sometimes the EPS will be reasonably low, whereas market price will continuously increasing because the investors' confidence over the company's future earnings will be very high. So therefore, the investor is prepared to buy the stock even at higher price. So therefore, the P ratio obviously will increase. Similarly, when investors' expectations of the company's growth potential, then also the P ratio will be very high. So if the investor finds the future potentials of the company, growth potentials of the company is very high, then the investor is prepared to buy the stock at very high price. So the stock price is high, whereas earnings are low or at reasonable level, EPS at reasonable level. So the price earning ratio will be higher. So normally the P ratio sets the sectors, industries benchmarking. For example, recently if you see the pharmaceutical company's price earning ratio, which is very high, the average Indian pharma sector's P ratio is 41, whereas the public sector organizations, particularly government banks, P ratio is just 10. You can compare the private sector pharma companies as well as government sector banking companies. The P ratio is very different. Even in the same banking sector, you can compare the government banking companies P ratio, which is 10, and private sector P ratio companies, which is 17. The industry average is 17. So therefore, the investors may expect more efficient, more dynamics, more business growth and revenue growth, earning growth of private sector when compared to government sector. That is why the current market price of private sector companies are very high when compared to government companies. So it results in higher PE ratio. Now we can understand how the price earning ratio is calculated. The formula for calculating price earning ratio is the current market price of the stock divided by earning per share. Please note that the current market price is fluctuating on daily basis. You can take the closing price of the stock for a particular day. That should be divided by earning per share. The latest earning per share available can be taken to calculate the price earning ratio. The price earning ratio shows the number of times the stock is priced when compared to its earning per share. For example, if the P ratio of the stock is 10, it means to earn 1 rupee earning per share, the market price is 10. It means if you invest 10 rupees, you will get EPS of 1. So if P ratio is very high, then the market price is high. If P ratio is less, it means the market price of the stock is less. So therefore, the price earning ratio is basically shows you whether the stock is overvalued or undervalued. For example, the current market price of the stock is rupees 100 and its earning per share is rupees 5. So then the P ratio is 100 divided by 5, you get 20. That is 20 times of its market price. So the EPS of the stock is, the market price of the stock is 20 times of its earning per share.